It was a bloodbath overnight for equity markets after a difficult day in Northern Hemisphere markets. Investors are fretting over more bad news to come after weak data results from the US. Currently, markets are down around 3.5% across the board, while the UK market was down by over 5% in one day alone. The big news came after AIG's hefty fourth quarter loss of $61.7 billion. The US government is once again having to pull the checkbook out, which did in fact give their share price a slight boost overnight. Although remember, they are trading at around 1% of their value from last year. Again, following this rough night of trading, investors ran for the covers back to the US dollar, which traded higher, while long-end US Treasury bonds, which are perceived as being safe, were well supported. So why has this happened? Well, recently, iconic US investor Warren Buffett released his annual letter to shareholders. Buffett is well known as superseding Bill Gates as the richest man in the world last year, but has since seen his company's share price halve as a result of fluctuations in markets. However, it still trades at $73,000 per share. Buffett is seen as an investment guru and as an informal advisor to President Obama, so his comments are well read. His comments shook the market after he said the US economy is in a shambles and will be throughout 2009 and maybe longer. Other news saw one of the world's strongest banks, HSBC, announce a new rights issue to raise $17 billion. This showed that they are also feeling the wrath of this recession. With investors looking to buy US dollars, our own New Zealand dollar continues to fall. It is now trading in the mid 49-cent range and really feeling the downward pressure. International beef markets are really taking a wait-and-see approach at present. With all the turmoil around the globe, demand for our own beef products has fallen off. Demand in Asia has dried up, while the beef slaughter in the US has increased a lot over the past few weeks. More dairy cows are being killed as a result of lower milk prices. This is also coupled with higher input costs for feedlot operators, which is forcing them to kill bulls earlier. However, while there may be some short-term weakness for this market, and this is reflected in schedule prices recently, there are indications of much lower cattle numbers down the track, which should help to tighten up this market later this year.